Everyone. Welcome to this press briefing. This follows the conclusion of the MPC's 125th regular meetings, which was held from Monday, 28th July 2025, to evaluate recent economic developments and risks to the inflation outlook. This briefing summarizes the key discussions and the committee's decision on the monetary policy stance. Since the last MPC meeting in May, the global economic outlook has become more challenging with increased economic and trade policy uncertainties. The prolonged bilateral tariff actions and retaliatory actions amid rising geopolitical tensions are projected to constrain global growth. According to the IMF, global growth is likely to slow to 3.0% in 2025 from 3.3% in 2024. Alongside the slower growth prospects, the pace of disinflation has moderated, and in response, financial conditions remain restrictive with potential spillover to emerging markets and developing economies. However, the improved domestic macroeconomic conditions are expected to moderate the risk from the global economy. On the domestic front, the economy was buoyant in the first quarter of 2025 with an annual GDP growth of 5.3% compared to 4.9% in the same quarter of 2024, driven by increased activity in the agriculture and services sectors. Excluding oil, the economy grew by 6.8% compared to 4.3% over the same comparative period. Beyond the first quarter, the bank's high-frequency real sector indicators pointed to sustained pickup in economic activity. The Composite Index of Economic Activity, or the CIA, grew by 4.4% year-on-year in May 2025 compared to 3.4% in the same period of 2024. International trade activities, consumption, construction, and tourist arrivals contributed to the improvement in economic activity during the period. The latest business and consumer confidence surveys reflected improved sentiments on the back of easing inflationary pressures and strong optimism about economic conditions. Since the last MPC meeting, headline inflation has declined further to 13.7% in June 2025 from 18.4% in May, the lowest reading since December 2021. The deceleration was underpinned by the tight monetary policy stance, fiscal consolidation, easing food supply constraints, as well as the strong recovery of the cedi. In line with the easing underlying inflation pressures, the bank's main core inflation measure, which excludes energy and utility items, has declined markedly. Similarly, inflation expectations by banks, consumers, and businesses are broadly anchored. Growth in monetary aggregates remained subdued during the first half of the year, primarily due to the tight monetary policy stance, strong liquidity management, and reduced government borrowing. In line with the disinflation process and easing inflation expectations, interest rates at the short end of the money market have declined sharply, and in turn, reduced the cost of government borrowing. Data on budget execution indicated a strong commitment to fiscal consolidation as expenditures adjusted within set targets to accommodate the revenue shortfalls during the first half of 2025. As a result, the overall fiscal deficit on commitment basis was 0.7% of GDP, outperforming the budget target of 1.8% of GDP. The deficit was largely financed from domestic sources. As at the end of June 2025, the total public debt had declined to 43.8% of GDP from 61.8% of GDP at end December 2024. And this was due to the appreciation of the CD, lower domestic borrowing, and the external debt restructuring. In the banking sector, the financial soundness indicators reflected continued asset growth, improved solvency, liquidity, profitability, and efficiency in the first half of the year. The non-performing loan ratio eased in June 2025 on account of lower growth of non-performing loan stock relative to credit. Continued improvement in the economic conditions, ongoing recapitalization efforts from capital injections and profits, coupled with the implementation of strict credit underwriting standards, should enhance resilience in the banking sector. The external sector has improved markedly, with a record current account surplus of $3.4 billion in the first half of 2025, supported mainly by higher prices and increased production volumes, talking about gold and cocoa. The current account surplus, together with the outturns in the capital and financial accounts, culminated in an overall balance of payment surplus of $2.2 billion, significantly higher than the $588.5 million recorded in June 2024. On this score, our gross international reserves stood at $11.1 billion as at the end of June 2025, which is equivalent to 4.8 months of imports of goods and services, compared to $8.9 billion or 4 months of imports cover as at end December 2024. The external sector outlook is positive, and this is anchored on favorable commodity prices and improved remittance inflows, despite the resumption of external debt service. On the back of the strong external sector performance and increased reserve accumulation, the cedi has further strengthened against the major trading currencies. And in the year to 25th July 2025, the cedi appreciated by 40.7% against the US dollar, 31.2% against the British pound, and 24.2% against the euro. Overall, the committee noted that macroeconomic conditions have significantly improved, inflation expectations are broadly anchored, external buffers have strengthened, and confidence in the economy is returning. The July forecast also shows that headline inflation is expected to decline further in the third quarter of 2025 and trend within the medium-term target of 8 plus or minus 2% by the end of 2025, earlier than initial projections. However, there are upside risks to the inflation outlook, which include potential supply chain challenges emanating from the global trade tensions, an upward adjustment in utility tariffs. These notwithstanding, the impact of these risks on inflation are expected to be offset by appropriately tight monetary policy stance and continued fiscal consolidation. Given these considerations, the MPC, by a majority decision, voted to lower the monetary policy rate by 300 basis points to 25.0%. And looking ahead, the committee will continue to assess incoming data and likely reduce the policy rate further should the disinflation trend continue. The committee remains committed to the price stability mandate while creating conditions for inclusive and sustainable growth. And the next Monetary Policy Committee meeting is scheduled for September 15, 2025. This meeting will conclude on September 17, 2025, with the announcement of the policy decision. I thank you.
Thank you very much, Governor Dr. Johnson Pandit Esiama. If you just joined us online, on radio or on TV, you are just watching or you listen to the Governor Dr. Johnson Esiama, who is also the chairman of the Monetary Policy Committee. And let me also say that all the 7 members of the Monetary Policy Committee are here with the governor, the head of research, the head of treasury, and our external members, who are Professor Abo and Professor Ebo Texan. And of course, the first and second deputy governors are members of the MPC. Let me thank you once again, Governor Dr. Johnson Esiama. So to the press, you've listened to the governor. The monetary policy rate has just been reduced by 300 basis points. We are going to have our usual interactions, but kindly be brief. And also know that in the past few weeks, we've had a lot of other information on some of the questions that you may have to ask. I'm only preempting. So you mentioned your name, and also you mentioned the radio station that you are representing. But let me just say this, Chairman